All right. Okay, we're off. Well, welcome everyone. As the tradition has now become, every quarter I give these updates on where we are in the markets. And as you probably know from the last few weeks, it's going to be a very interesting look at what's going on right now. And obviously, what does this mean for where we're going to head in the next few weeks and months? So, normal disclaimers apply, which means none of this is financial advice. Everything that I say and you see is general advice only. Nothing is specific to your needs and circumstances. Nothing is a recommendation to buy or sell any financial instrument. The only good I'll always like to start with a quote, but the only logical one that made sense was the old Chinese curse of "May you live in interesting times," because nobody knows what's happening from day to day at the moment, especially with the current incumbent of the White House making things so interesting for us. As we'll see in a moment when we switch to the charts and have a look at the US stock market, this is the S&P 500 on a monthly chart, and it's log scale. And while it does feel like there's a hell of a lot of blood on the streets, as you can see there, we've hardly moved really in the long-term scheme of things, and we're still very much in the middle of the range. Yes, we're pulling back, but there's no technical damage done to the trend at the moment. As you can see there, the ceiling was that 6,000 level, which obviously a big round number, obviously psychologically important. Market couldn't sustain its time above that, and it's now started to pull back. You can see the lower trend line there is going to be around about 5,000 if the market connects with that line. So that would be the one to watch on a monthly basis. Zooming into the weekly chart, you can see there we got that double top just above the 6,000 mark there, which now, as we can see, is turned into a bull trap. All the longs were trapped. They're now trying to unwind their positions, and we're getting this massive de-risking and this volatility event as the market's falling. But even in that time scale, you can see we still haven't really moved that much. It's not like we're not seeing huge red candles at this stage, although there's no doubt the trend that we were in is more or less ended. And I guess the big question on everybody's lips is this it? Is this the top that we've been waiting for? Is this the start of the bear market, or is this really just a correction in the big scheme of things? And so if we take a look at the 2007 top, we can see that there's a couple of points along. This is I think this might even be a daily chart, but it spans quite a number of months. So these tops do take a hell of a lot of time to form, and you can see there might be a couple of spots where we are. One might be we've had the double top, and I don't know if this is going to work or not. No, oh, there it is. This might be the double top we've just had, and then we're here. So we're in the first of the series of corrections, or else this is the double top. These two larger tops here is the ones we've had, and we're now coming down on that second leg there. It's very difficult to draw any comparison, especially when the sample size is one. So we've got no idea whether this has got any reflection on what's happening in the market right now. In other words, we need to be a little bit cautious when we're looking back on previous examples of when the market's topped. But anyway, that gives you a little bit of a guide. Either it's a correction or it's some sort of topping pattern that's still got to unfold. If we have a look at the Ichimoku chart, though, you can see we're still definitely in bullish territory. It hasn't even connected with the cloud yet. The cloud's sitting below at that 5,000 to 5,500 level. Normally, when the price gets into the cloud, especially having spent so long away from it, usually the first touch is a bounce. And you can see that if you look back on the chart round about here. The market came back into the cloud, just touched it, and then took off again. So we should expect that we'll get some sort of rally once that happens. Whether that takes us to a new high or just a lower high, we'll have to wait and see. So the big question is, could we have seen this coming? So let's indulge ourselves in a little bit hindsight bias and have a look at the market internals, because there was some clues there. This is the bullish percent index, so the percentage of stocks in the S&P 500 that are bullish at any one time, and you could see it actually made that big lower high there, or that deep lower high, if you want to call it that, back at the start of February. And that was the sign, I suppose, that the game was up. There was clearly already stocks being sold down at that point, and that came to 3 or 4 weeks before the market actually reacted. There's now 38% of stocks which are bullish, which is not nothing. That's more of a third of the market still hasn't been sold off badly enough to damage it technically. So that does give us some hope that we might see a rally at some point. If we look at the stocks above their 200-day moving average, it's a similar story. We got that lower high came in just for the first week of February, actually, but before the market reacted once again, and it's now sitting down at 41%, which is again quite a big number considering what looks like a lot of damage on the price chart of the S&P 500 itself. The discretionary versus stable. So this is often considered a very good leading indicator of the broader market. It tends to react before the market does, and you can see it actually topped out with the first couple of weeks in January, really, and then it started to drop dramatically. So that was one canary in the coal mine, but an even sooner canary, if you want to stretch the analogy, was the semiconductors, which actually topped out back in the middle of last year. It's a bit hard to say that was a good forecast that the market was going to collapse, because it took a long time to unfold. So it's not a very good timing tool, but the signs were there, that the appetite, particularly for these large growth AI stocks who buy a lot of semiconductors, obviously, a lot of that froth, if you like, was perhaps not going to carry on. And of course, we now get the correction. The last one on this little series is the home builders, which they're often a bellwether of the broader economy as well. So when they start selling off, that's a sign that things may not be as good as we thought they were, and that topped out back in September. So the signals were there, but it was very difficult to say, okay, I'm going to sell out of everything, unless you're some people. It's very difficult to say I'm just going to sell out of everything and not participate, because you might, if you'd sold out that early, you would have missed a very good stretch of the rally. The advanced decline line, it's kind of gone sideways. It's not sort of done up and down like a lot of these other indicators have, although it did top out earlier than the market did as well. And once again, this is another sort of green shoot, if you want to call it that makes me think that we're not in the start of a bear market, because if we were, we would be seeing a lot more downside on these kinds of measures. But the other thing that probably tells us is that the selling is patchy. It's not across the board, and we can see that a little bit if we look at the relative performances of the three big indexes. The S&P 500 is down about 5%. But the NASDAQ 100 is down about 7%, so that's the sort of tech sector, if you want to call it that. And then you've got the Russell 2000, which is the small caps, and it's down even more. It's down about 9%. So you can see more or less where a lot of the selling's been going on, and maybe some of the more what you call defensive areas of the S&P 500 have actually still been holding up a little bit. So onto the sentiment indicators and the yield curve. This has been coming back into what we call the normal shape, which is low on the left, high on the right. And you can see from those shadow lines where it's been very flat. And for some months last year, it was actually inverted, which means it was high on the right, low on the left. So what does this mean? Well, when the yield curve goes inverted and then turns back the other way, that's usually the point that precedes a US-led recession. And we can see that on this chart here. This is like this actually is a chart of that of the quantifying that inversion, quantifying the yield difference between 2 points on that curve. And when it gets down into the pink area, that's when the yield curve is inverted. But what's interesting is you can see that when it goes inverted and then turns normal again, goes above the pink area, that's when the recessions come in. That's those gray vertical bars that you can see on the chart there. So now we've had the deep inversion, one of the deepest in living memory here. And now we've had the move back towards normal. That means that if we're going to get a recession, it's very close. It's basically this year. We can also see that on this chart here, which is the New York Fed used the yield curve as an input to produce a probability of a recession in the next 12 months. And what's interesting here is that it's very difficult on this timescale to find what month it was, but that 72 value was sometime last year, meaning that there was a 72% of a recession coming in the following 12 months after that, which again means probably the first half of this year. It's now dropped to 34%, but that's looking forward to the next 12 months. So, it may be that this time next year we're not in recession, but we have some big 9-month one stuck in the middle. So, the odds favor us moving into a US-led recession, and just sort of that makes sense, really, if you see what's going on around us at the moment. On the sentiment indicators, this is another one that kind of told us the correction was coming. It spent a long time in this so-called bullish extreme, so it's kind of inverse from what the market is. And what this shows you is that when it goes below that level, there's way more calls, contracts open than puts. So when everybody's on one side of the market will tend to do the opposite, and that's what we got this time. It took a long time for that to happen, so it wouldn't have been a great timing tool to sell everything and then just let this unfold. So, but the sign was there, and it's now correcting back into that neutral territory. This was another way of looking at that put-call ratio, which is to look at the 5-day moving average. And this one's been very reliable. You can see every time it's dropped below that 0.5 line, which means there's 2 calls for every put that's in the market. Almost every time it's been a decent sized correction in the market, and this time was no different. It dipped down for about a day or two, possibly. It's a bit hard to see on that time scale, but once again we got the correction soon after. The VIX is the conundrum for me at the moment, because normally when we get this size of sell-off, we're down 10% almost without a stop. Normally in those sort of circumstances, you would expect the VIX to be shooting much higher, and we're not seeing that, as you can see on this chart here. We've just barely crept into that region that I would call the elevated risk rate area, between about the low 20s and about 40. And you can see what happened back in August there when the Japanese central bank tweaked their interest rate. The VIX went bananas for a few days and then sort of came back to normality. So it's a little bit of a conundrum why it's not reacting, and again, this is another reason which makes me think we're probably seeing some buying going on behind the scenes, because the main way that the VIX is priced is portfolio managers buying protection for their holdings rather than selling them. So if people aren't buying protection, that tells me that maybe they're actually buying stock at discount at the moment, and maybe we're close to some sort of inflection point where we'll get a rally. The other thing that sort of tells us that is the fear and greed index is way down, and you can see on the chart at the bottom, which is basically a timeline of the odometer, that it's one of the lowest points it's been. So we've had extreme greed over here on the right of the chart, which doesn't make sense considering some of the corrections we've seen in the past. And obviously, it mean reverts, goes between 0 and 100, this thing. So again, maybe there's just a hint of something there that we may be close to a bottom. The other thing that tells us that, or the other piece of evidence we can put towards that thesis, is that the seasonality, the winds of seasonality, are now blowing to the north, if you like. On the 12-month seasonality, January, February are often rocky starts, and we've certainly had that here. You can see that the actuals down the bottom there, which does show pretty well the Well, to me, it's almost a match because we had sort of two big lows, and that's basically what the cycle is telling us. But as you can see there, the February and March into April tend to be the one of the most bullish periods in the market. So if we're going to get a correction, that means that the winds of the cycle will be behind us as well. And you can definitely see that if we put the average returns on a bar chart. March and April together are kind of the two strongest months outside of that run up to Christmas. So that might be something worth having, and that also, strangely enough, coincides with the presidential cycle, which now we're into the so-called post-election year. And as you can see there, January and February also looking rocky, but then March, April, even into May is quite bullish on this cycle as well. So if that does tend to be the case, if all of these things are kind of pushing in the same direction, perhaps we get a little bit upside at the bottom of this correction. The decade cycle tells us that year 5 is the one-off, if not the most bullish year there is, and we're now in year 5, 2025. So you can see there that that's another kind of move in this direction. So who knows what will happen, obviously, but maybe we get some volatility early on in this year, and then things start turning more positive again. The last piece of evidence I'll offer on this is the where we are in the so-called 18-year real estate cycle, and we were hoping to have Phil Anderson here tonight, who's kind of one of the proponents of this and was sort of key in popularizing this 18-year cycle. It's got a very good track record in terms of the number of times it has worked. The last one was 2007, 2008, of course, and now add on 18 years to that, and we're now coming into this so-called winner's curse area, which is when we're seeing interest rates falling. That's going to fuel house property prices, push the market higher. Eventually, it will get to a point where it's unsustainable, and then it'll all fall over. And according to the cycle, that should be into 2026 next year. The stock market often precedes that. We saw that in 2007. It topped about August or between August and October of 2007. And then we got the housing market crash in 2008. So we'll see if that happens this time, but certainly one to watch. On to the local market, and poor old Aussie 200 was going along quite well there. It broken through that 7,600 level. It was traveling along quite nicely. It got up to that 8,600 level, and as you can see there, it just ran out of steam. And as the old saying goes, when the markets fall, the correlation goes to 1. So as soon as the US markets started falling, the Aussie stocks were not far behind. However, it's that 7,600 is a key level. You can see it's been resistance a number of times before, so there's a good chance we'll see it become support if and when the market hits it, and it definitely looks like it's heading in that direction, which we can see much clearer on this weekly chart here. You can see it's heading down almost in a straight line towards 7,600 again. So we would expect to see a little bit of demand pop up at that level. Another reason why that 76 level might be key again is because of the Ichimoku chart. The cloud is sitting right on that 7,600 to 8,100 level. So given the fact that we would expect the price to bounce out of the cloud, and that we've got that hard line of support at 7,600 level, then that should be an area to watch when it gets to that point. And comparing ourselves to the other indexes, well, you can see that the Hang Seng has been the sort of poster child for bull markets in the last few months. It's up very nicely at 17% higher. The Nikkei is about flat for the year, and then we've got the poor old S&P 500 and the ASX 200 down in the proverbial toilet there, about 5% lower for the year. On to the currencies, and the US dollar. Well, of course, with all this turmoil and the erratic behavior of the current incumbent in the White House, nobody really knows what's coming at them down the track with tariffs and et cetera, et cetera. So there's a lot of uncertainty in the market, and that's feeding into a weaker US dollar. As you can see, it's selling off on a technical basis there. That 102 level is key because it was the breakout point. You can see the number of times it's been touched from below and above. So we might expect that that will be some sort of line in the sand. It's also back into that pattern as well. So you might even make the case that the last little leg up and down we've seen is a false breakout of that little consolidation area there. So maybe we just sort of wind around in there for a little while. Of course, the weak US dollar helps all the other major currencies. So we're seeing the Aussie dollar. I mean, it's been struggling lately. It broke through that 70 level quite a while ago. It's now sort of meandering down towards 60, but it's a little bit of a green candle there, as you can see towards the end. 60 is obviously the key level for the Aussie dollar. You wouldn't want it to break that. So 60 to 70 is probably a little bit hopeful to see it any higher than 70 at the moment. So yeah, we'll have to just see how that one plays out. The euro, there's a little bit hard to sort of divine, I should say, what's going on in this chart, because we kind of popped out of this downtrend area, then we sort of came back into the pattern, then we reached down, hit parity with the US dollar, and it's now back up, contained in that 105 area, above that 105 level. That 105 level has been quite instrumental, both as well, mainly as support, really, and that goes all the way back towards the 90s as well. So you can see it just dipped below lately, which now looks like a false break, and it's now popped back up again. So as long as the euro can maintain that 105, I think it's going to be more bullish than bearish. The Japanese yen, well, it's trying to make that bottoming pattern. You can see down about around about that 0.0062 yen to the dollar area. You could even try and argue for a little inverse head and shoulders here, but it's got work to do to get it anywhere close to being bullish again. It's damaged goods at the moment, you might say, but a weak dollar won't do it any harm. Bitcoin, of course, we saw it hit that 100K mark last year, so that was party time, but it couldn't really hold on to it. Got as high as 109.50, which is a decent level, but just lately you can see it broke down out of that pattern, probably double top, you might call that. The next support level I can find is that 72,000 level, so wouldn't be a surprise to see it get back there, but it certainly doesn't look like it wants to go higher just at the moment. And rounding off on the commodities, well, crude oil, this just keeps teasing us here at this 66 level. It's had so many attempts at it, keeps finding demand, and the sellers just keep driving the peaks lower and lower and lower. So who knows? I do think if we see a break of 66, it will be quite a fast move down, given that buildup of energy, if you like, that's been going on there. But in the meantime, 66 is the make or break for oil. On copper, well, it's got its own make or break level, which is this 465 area, which it's tried a number of times to get up and over. This is on a monthly chart as well. It's got up for part of a month, and then it's sold back down and almost always closed below the month, but closed by the end of the month. The last candle is obviously only a partial month at this stage, so we'll have to see if it can maintain that level. If it can we can get a couple of monthly closes above 465, there should be more upside to come in copper. Otherwise, we'll be back into that pattern and just winding around again. Iron ore, similar story. They're all kind of very close to their levels at the moment. 100, big psychological level, if nothing else. But you can see there the number of times it's spent at that level. It does look like it wants to break down through that level. I think if we see a contraction of international trade and tariffs on China, that's going to be bearish for iron ore, obviously. If it does break through 100, then 80 should be the next level, and see if it can try and hold that area. And finishing up on gold, gold is always the star performer. It has been lately. It's actually run so far. I've ended up putting this on a log chart, which I don't normally do. So you can see it's broken through that 2000 level. It's taken off like a rocket, and it hasn't really looked back at all. I keep saying it's looking extended, and it's probably going to pull back, but it doesn't really care what I say. So if you're holding gold, well played. So just to summarize that, so we're clearly in some sort of deep correction. I think we can call that for the US stock market at the moment. Whether that turns into something bigger, we'll have to see. There's no sort of obvious line of support that's going to make this thing turn around. So it's probably going to be more news driven than anything else. What happens next? On the Aussie 200, it's heading back for that 7600 level, which should become support. And we're obviously seeing that weakening US dollar now in the currencies, which is helping the other majors. But Bitcoin itself is also correcting at the moment. And on the commodities, we're seeing weakening on the oil price, and metals, particularly copper and gold, are looking quite bullish. You can get in touch with me here, follow me on YouTube, blah, blah, blah. You can check out the strategies I trade at smartsystematictrading.com. And with that, I will wish you good luck, good trading for the next quarter. Thank you, and bye for now. Time for a question? All right.
Because the markets don't like uncertainty with this Trump tariff threats, that is probably the main cause for the weakness, or do you see it for more systemic?
Well, I think there's two things really. One is the market was overbought. You know, it was probably time for a correction. This has been the catalyst. There's no doubt about that. But yeah, I think you've got a good point. People knew they've heard Trump talking about tariffs, but nobody really kind of had it priced into the market. People were thinking, oh, you know, he'll change his mind, or which he did at the start. You know, he said, I'm going to do it, and then I'm not going to do it, and then I'm going to do it, and not going to do it. So when he finally did it, and now he's doing it sort of globally with things like aluminium and steel and stuff, there's a lot of people thinking, well, this is not priced in. So rather than keep your money on risk, they're just basically de-risking. So reducing their exposure to the stock market, and that money's probably spraying into gold and bonds and other places at the moment, just as a safe haven. Yeah.
Is there a strong correlation, do you think, with the NASDAQ and Bitcoin?
Yes, I do. Yeah, I think it's basically it's so when you know, when Bitcoin first started, people were saying, oh, well, first of all, it's money. You know, it's going to be like the US dollar. It's going to be something you buy and sell. Then they said, oh no, it's more like digital gold. It's like a store of wealth. Now I think it's just a big tech stock. You know, it acts more like a Nvidia or a Tesla or one of those big growth stocks in the way that it moves. I mean, it's still got its own signature, and it's a lot more volatile than a lot of those other things. But yeah, I think if you were looking for correlations, that would probably be the place I would be looking. Yeah. Yeah. All right.
Yeah, on the fear and greed index, I've heard just recently that when it goes into extreme fear, it's actually a buy signal. What do you think?
Yes, I would agree with that. Yeah, you can see from that chart of the timeline. I mean, it's been down as low as 20. That's probably I mean, the market's cheap at the moment. You know, no way. If you've got dry powder lying around, there's not a recommendation, but you know, it's probably not a bad time to deploy it.
Thanks.
Thank you, everyone. Enjoy the rest of the show.
Alan, on behalf of everyone here and everyone tuning in, I got your little thank you present for your
Oh, that's very kind of you, Paul.
presentation again. Most eye-opening. Thank you very much.
Thank you. Thank you very much. Thank you, everyone.